back. Joe Battipaglia, Jerry Bowyer, Jim LeCamp. Thank you for your patience, gentlemen. Joe Battipaglia, you have been a pessimist on the economy and the stock market, and frankly, you're having a great year on that. You've been dead right. You're right on the money, so kudos on that. I want to ask you, and I want everybody to chime in, please. You got a bunch of data today. What does it tell you? First of all, very bad consumer price number. Somebody said it's the worst in 17 years. On a 12-month change, the headline CPI is just about 5%. That's the headline, including everything. It's 8% over the last 3 months. However, the core consumer price index is gradually climbing, as that chart shows. And in drips and drabs, it's worked its way up to about 2.5%. The other one, let's go and look at industrial production. This was a surprise. I'm sorry, there's average hourly earnings because of the CPI. Earnings in real terms, this is adjusted for the CPI, have been falling pretty steadily for the last 2 years. Now, quickly, we'll look at the industrial production. We had a positive surprise. This month was up 0.5%. It is the best performance in, I think, something like 11 months. All right, let me stop there. Joe B., what does this mean? How does this affect your view?
What it all means to me is that the consumer is in dire straits. What they pay money for every month is going up in price, but the value of their biggest asset is falling. Their earnings are not keeping up with the inflation rate. Therefore, their ability to accumulate wealth, or better than that, to pay down their debts, is out the window. So the consumer has rolled over, and hence the economy has contracted significantly. Now, we have held on to the belief that perhaps this global decoupling and our export demand and infrastructure demand globally is going to carry us forward. But that is starting to break down. The southern rim of Europe has entered into recession. The rest of Europe is teetering. Japan is not showing great improvement. And even the Chinese now are talking about, after the Olympics, having a slower growth rate in their economy. So I think the linkage is still there. The times ahead are still treacherous. So the economy is going to be a subpar performer for the rest of the year. And unfortunately, credit conditions will not be improving anytime soon.
Will stocks be a subpar performer, Joe?
Oh, I would say yes through the rest of this year. There's still some downside risk here because analyst expectations on earnings ultimately are just too high for the rest of this year going into next year.
Jerry Bowyer, let's give you a shot at all this. Production surprisingly up today. Terrible CPI number. Yesterday, as you know, producer wholesale prices, Jerry, another terrible inflation number. You know, Bernanke just dissed all this. It's incredible to me. He didn't focus on it. However, core retail sales yesterday, Jerry, came in pretty good.
Yeah,
0.4%, 8% for Q2 annualized, and business sales through the month of May came in at a double-digit rate. So you heard Joe B. What's your take, Jerry Bowyer?
My take is that Joe B. was right, but for the wrong reasons, because he just laid out that case again about the consumer, absolutely ignoring the latest month of decent consumer growth. Core consumer was strong. Regular consumer, up 2.5% year over year. The consumer has not fallen off the cliff. The consumer isn't falling off the cliff.
Jerry, why don't you ask the chairman of General Motors why he's predicting a 14 million unit run rate for cars and light trucks after a run rate of close to 17 for 2 years. Come on now.
And if I were in Detroit, I'd say that's definitely a recessionary scenario.
It's not just Detroit, it's the whole industry.
Let me answer the question, Joe.
Well,
but the whole country isn't Detroit, and the whole economy isn't the auto sector. You're right, of course. You can look at the housing sector and see weakness, and you can look at the auto sector and see weakness.
And you can see it in large ticket items. And you can look at the agricultural sector and the energy sector and see strength. And manufacturing other than autos are strong. So it's still a slowdown, not a recession. The problem with agriculture and energy is that it ends up being a tremendous tax on the rest of the economy. So you're looking at 5% of the economy benefiting while 75% struggles. And therein lies your problem for the gross economy. That's the only way you can explain. It's the only way you can explain GDP grinding to a halt from a 3% run rate to 1 or less, which is where you're stuck now.
And what's it going to be in the second quarter? 1 or less?
1.5. What number you want? It's not 3.
1.5, 2%. It's not negative. It's not recession.
Right,
Joe, here's the thing.
That's why Ben Bernanke said yesterday.
It's inflation, not recession.
And the stimulus check.
It's not a recession.
Okay.
All right, Jim LeCamp.
6 months of growing unemployment. It's not a recession.
Jim LeCamp.
That's growing like mad. Didn't you notice?
All right, hang on. I got to take a commercial break. We're a profit-maximizing company. Jim LeCamp, I go to you first on the next segment. You and I are out having a cup of coffee. Actually, that was a great great discussion, gentlemen. Thank you. Kudlow and Company, we're going to start with Mr. LeCamp and then more with Joe B. and Jerry Bowyer. I'm Kudlow. Please stay with us.
Russell Investment.